Listen, last Friday we saw something very strange in the silver market, a pattern that made a lot of people question whether the price is being manipulated. And I'm not using that word lightly. I'm not throwing around conspiracy theories. I'm talking about observable behavior in the market that just doesn't make sense unless someone is actively interfering with price discovery. Today, I want to analyze that bizarre movement. I want to explain why it matters right now. And I want to show you why silver's price could explode in the coming days, months, and years. At the end, I'm also going to talk about some predictions for 2026 that are getting serious attention. Not from random internet accounts, but from people who understand market structure. So let's go straight to the point. When we analyze silver's chart on Friday and compare it with gold during the same period, gold is moving normally. It rises. It corrects. It reacts to market forces. It's natural price action. But silver is clearly stuck. It's trying to rise. It's attempting to break higher, but it cannot break above 74.55 per ounce. Every time it approaches that level, every time buying pressure pushes it towards 74.55, something pushes it back down. This isn't natural resistance. It's not sellers defending a technical level. Something is actively preventing silver from trading above that price. And it's worth remembering that JP Morgan already paid the largest fine in history for spoofing and manipulating the silver, gold, and platinum markets. That's documented. That's a fact. That's not a conspiracy. I'm not accusing anyone specifically of doing this now. I don't know who's behind it currently. But anyone who follows the silver market knows movements like this are not normal. They're not how free markets behave. And here's what's most interesting. Historically, when silver gets artificially capped, when its price is held down by intervention rather than genuine selling pressure, the breakout tends to be fast and violent. The spring gets compressed, pressure builds, and when that cap finally breaks, the price doesn't drift higher gradually. It explodes, it gaps, it teleports through levels, because all that suppressed buying pressure, all that delayed momentum releases at once. So understanding that this strange behavior is happening right now, at this specific moment in the silver market cycle, is critical, because it tells you we might be very close to one of those explosive breakouts. Quick disclaimer before we dive deeper. This is not financial advice. This is market analysis and education. Do your own research. Consult professionals. Before making any investment decisions, don't risk money you can't afford to lose. Now let's break down what's actually happening in the silver market and why the next few weeks could be more important than they appear. From a technical perspective, silver just exited a long consolidation. For months, silver was building a base, chopping sideways, frustrating traders, testing everyone's patience, but that consolidation wasn't bearish. It was accumulation. How do we know? Because of what's happening underneath the surface. What are we seeing? Volume is growing on attempts to move higher. Every push toward resistance comes with increasing volume. That's not distribution. That's not weak hand selling. That's buyers absorbing supply. Corrections are getting shorter. Each pullback is shallower and briefer than the last. Price isn't making lower lows. It's making higher lows. That's structural strength. We're seeing strong defensive support levels. Every time silver dips, buyers appear immediately. The floor is solid. Support isn't breaking. This normally indicates accumulation, not distribution. When weak hands are selling and smart money is distributing, you see declining volume on rallies and heavy volume on sell-offs. You see deeper corrections. You see support levels breaking. But we're seeing the opposite. We're seeing volume increase on rallies. We're seeing corrections get shallower. We're seeing support hold firm. That's a classic accumulation pattern. That's what happens when strong hands are building positions while weak hands are getting shaken out. And when you combine that technical setup with the artificial price suppression at 74.55, you get a powder keg. You get a setup where a breakout becomes inevitable. Because you can suppress price temporarily. You can cap it for days or weeks. But you cannot change the underlying supply-demand dynamics. You cannot stop accumulation. You cannot prevent the structural forces that are building pressure. Eventually, the cap breaks. And when it does, the move is violent. But the technical setup is only part of the story. The physical market is sending a much clearer message. In several countries, silver coins and bars are already being sold well above the spot price. These premiums are expanding, not contracting. In normal markets, when the spot price rises, premiums tend to compress. Dealers can get supply easily, so they don't need to charge as much over spot. But right now, even with spot at $74 or $75, premiums are staying elevated or even increasing. Why? Because physical metal is tight. Dealers can't get supply as easily as they used to. Delivery times are extending, wholesalers are rationing. And when you can't get metal easily, you charge higher premiums to ration what limited supply you have. This premium expansion shows that the physical market is stressed. That real metal, actual bars and coins, are harder to obtain than the paper price suggests. And when the physical market tightens, when premiums expand, when delivery times extend, The paper price cannot hold its suppression for long, because eventually arbitrage forces the paper price to rise toward the physical price. If physical silver is trading at $80 in the real world while the COMEX paper price says $74, that gap creates an opportunity. Buy paper at $74, take delivery, and sell the physical at $80. You profit $6 per ounce. And when enough entities attempt that arbitrage, when physical demand overwhelms paper supply, the paper price has to rise. It has to acknowledge reality. This is one of the reasons why the next few days and weeks could be much more important than they appear, because we're at the point where physical stress is building while paper suppression is maxing out. Something has to give, and what gives is usually the artificial cap, not the physical scarcity. Now let me show you why I believe we're living through a historic moment. The rally we've seen so far is just the tip of the iceberg. Before we talk about predictions, we need to understand why silver is rising. What's changed? What's different this time? First, the positioning structure. U.S. bullion banks have covered 29,000 short contracts on the COMEX since April. That's massive. That's an unprecedented reduction in short positioning. And here's what's even more significant. For the first time in history, they are net long in silver. Let me repeat that. For the first time in recorded history, the U.S. bullion banks as a group are holding more long positions than short positions in silver futures. They've flipped. They've gone from suppressing to accumulating. Yet, even after covering all those shorts, they still carry 18,000 gross short contracts, meaning they're still stuck. They're still exposed. They're in an extremely uncomfortable position. Why does this matter? Because it tells you the smart money, the entities with the best information and the most access, have changed their behavior. They've gone from betting against silver to betting on silver. They've gone from shorting to accumulating, and they did this quietly. They didn't announce it. They didn't publicize their strategy. They just changed their positioning. And when the banks that have historically suppressed silver start going long, when they flip their stance, it's one of the most bullish signals you can get, because they know something. They see something. They're positioning ahead of something. And that something is what we're about to discuss. Now enters physical reality. And this part is impossible to ignore. We are entering the 6th consecutive year of a structural supply deficit in silver. The 6th year. Not 1 year where demand exceeded supply because of a temporary surge. 6 years. Year after year, where industrial demand plus investment demand exceeds mining supply plus recycling supply. And the deficit is widening, not shrinking. And it's not just the deficit. China controls approximately 60% of global silver refining capacity. They mine ore everywhere. South America, Africa, Australia. But most of that ore gets shipped to China for refining. China turns that raw material into usable industrial bars. And China just implemented new export controls. They're restricting how much refined silver can leave the country. They're prioritizing domestic use. They're hoarding supply for their own industries. When the Shanghai premium proves this is real, physical silver in Shanghai is trading 13.8% above the COMEX paper price. That's not a small premium. That's not a few dollars. That's a massive divergence. If COMEX says $74, Shanghai is paying $84. Why? Because Chinese manufacturers need the metal. Chinese industries consume silver for solar panels, for electronics, for EVs, and they can't get enough from domestic refining. So they're bidding up the price. They're paying whatever it takes. And that premium tells you something critical. Silver is simply not being refined fast enough. Global refining capacity is maxed out. Even with prices rising, even with the incentive to produce more, the refineries cannot keep up with demand. This is not a temporary problem. This is structural. This is a bottleneck that cannot be solved quickly. And unlike other cycles, unlike previous bull markets in silver, the demand is not stopping. It's accelerating. Many people still think silver is just an investment asset, a store of value, a speculation. That's a mistake. That's outdated thinking. Forget what you think you know about silver. It's not just a shiny metal in your grandmother's jewelry box. Today, silver is the irreplaceable backbone of modern technology. It's not optional. It's essential for the two biggest trends shaping our future: the green energy transition and the global push towards digitalization. Let's break it down. Think about energy. Every single solar panel on Earth relies on silver paste for conductivity. Those photovoltaic cells that turn sunlight into power need silver. And right now, global solar installation is exploding. Governments are mandating renewable energy, they're subsidizing solar projects, and they're building massive solar farms. Every one of those panels needs silver. Then there are electric vehicles. An EV uses about twice as much silver as a traditional car. It's in the wiring, the batteries, the advanced charging systems. And EV production isn't just growing, it's growing exponentially. Traditional automakers are scrambling to convert their fleets. And new EV companies are scaling up at a breathtaking pace. Every single one of those vehicles needs silver. What about the device you're watching this on? Every smartphone, every laptop, every tablet, and every computer is packed with silver. It's in the circuits, the connectors, the switches. As global demand for electronics continues to climb, so does the demand for silver. And it goes even deeper. Think about the cloud, the internet, and the incredible rise of artificial intelligence. All of that computational power runs on servers in massive data centers. Those servers are loaded with silver components. With the AI revolution driving an insatiable demand for more processing power, the construction of these data centers is booming. Every dollar invested in AI infrastructure indirectly creates more demand for silver. Here's the critical point to understand. This demand isn't going away. It doesn't care about high interest rates or a looming recession. This is structural, non-negotiable demand. The world doesn't stop needing solar panels because the economy slows down. EV production doesn't halt because of a market correction. This demand is inelastic, persistent, and it's only growing. But here's the problem. While demand is rocketing upward, supply is stuck in the slow lane. You can't just flip a switch and make more silver. It takes a minimum of 7 to 10 years to bring a new mine from discovery to actual production. Think about that. If a massive new silver deposit were found today, we wouldn't see a single ounce from it until 2032 at the earliest. But industry needs the silver now. To make matters worse, existing mines are struggling. The average grade of silver ore, meaning the amount of silver you get per ton of rock, has been plummeting for decades. Back in 2005, a good mine might yield 15 ounces per ton. Today, you're lucky to get 4 ounces per ton. That means miners have to dig up 4 times more rock, using more fuel, more water, more labor, and more capital, just to get the same amount of silver. It's getting exponentially harder and more expensive to pull it out of the ground. Now let's zoom out and look at the bigger economic picture we're all living in. We have record levels of government debt worldwide. The US federal debt is approaching $38 trillion. Countries are consistently spending far more than they earn, leading to massive deficits. This constant creation of new money leads to the erosion of your purchasing power. Call it inflation, call it currency debasement. The result is the same. Your money buys less and less each year. Historically, in times exactly like these, what performs well? Scarce, real assets like gold and silver. Their value isn't tied to company profits or economic growth. Their value is tied to the loss of faith in paper currencies. And we are deep in that environment right now. There's another huge factor to consider, the gold to silver ratio. Right now, it takes about 56 ounces of silver to buy 1 ounce of gold. Historically, this ratio has been much, much lower. When this ratio starts to fall or compress, silver tends to outperform gold dramatically. Why? Because the silver market is much smaller and more volatile. When big money flows into precious metals, gold moves first, but silver moves faster and further once the momentum builds. It's the leveraged play. With the ratio still at 56 to 1, there is massive room for it to return to its historical average. Just a simple return to a 30 to 1 ratio, with gold at its current price, would put silver at over $140 an ounce. I'm not saying this is a repeat of 1980 or 2011, but history shows us a very clear pattern. When silver decides to move, it doesn't just creep higher, it explodes, it goes parabolic. In 1979, silver went from $6 to $50 in a matter of months. In 2010, it shot from $18 to nearly $50 in about a year. These aren't gentle trends, they're violent upward repricings. And the setup today, with massive industrial demand, structural supply shortages, and a shaky macroeconomic backdrop, looks remarkably similar. Some analysts are making some eye-popping predictions for 2026. Robert Kiyosaki, author of Rich Dad, Poor Dad, is calling for $200 silver. Others are projecting numbers like $250, $300, or even higher. Do these numbers sound extreme? Maybe. But consider this. The 1980 high of $50, when adjusted for the real loss of the dollar's purchasing power, is equivalent to somewhere between $400 and $600 today. Suddenly, those predictions don't seem so crazy. What makes this cycle truly different is that there's no cavalry coming to the rescue. In past price spikes, high prices incentivized a flood of new supply from mines and scrap recycling, which eventually crushed the price, but not this time. As we've discussed, new mines can't come online quickly, and there's no hidden stash of scrap waiting to hit the market. The supply deficit is real and structural. This means the next price move could be far larger and more sustained than anything we've seen before. But despite all of this, notice something strange. There's no mainstream hype. The news isn't talking about silver. Your friends and family aren't asking you about it. There's absolutely no speculative fever. And historically, this is exactly how silver's biggest moves begin, in silence. The smart money accumulates quietly while everyone else is distracted. The move starts, gathers steam, and only when the price is already much, much higher does the public finally catch on. By the time it becomes obvious, the biggest gains have already been made. We are not there yet. We are still in that quiet accumulation phase. And that is precisely where the opportunity lies. So let's sum it all up. The physical market is incredibly tight. We're in the 6th straight year of a structural supply deficit. Industrial demand from solar, EVs, data centers, and AI is growing and isn't affected by economic slowdowns. Supply cannot keep up. The broader economic environment of debt and currency debasement is a massive tailwind. The gold to silver ratio is primed for a reversion. And most importantly, there's no public mania yet. We are still in the stealth phase. When you put all of those pieces together, the question isn't if silver is going higher. The question is when, how fast, and how far it will go. All the ingredients are in the bowl. The fundamentals, the technicals, the physical tightness, and the macro backdrop are all aligned. We're just waiting for the catalyst, the spark that ignites the fire. That moment could be days, weeks, or months away, but the underlying forces are too powerful to be contained forever. Something has to give. When that artificial cap at 74.55 finally breaks, the move will be explosive. All that suppressed pressure will release at once. Those waiting to buy will enter simultaneously. Industrial demand will become urgent. Price will have to jump to find where supply and demand actually balance. That level is much, much higher than $74. The next few days could be the transition point, the moment when silver moves from stealth accumulation to public recognition, from undervalued to overvalued. Being positioned before that transition is the edge. That's the difference between buying at 74 and buying at 120 after the move has already happened. Subscribe and turn on notifications because we are tracking this in real time. We are monitoring whether that $74.55 cap breaks, whether physical premiums expand, and whether banks continue covering shorts. We are documenting the structural shift from paper suppression to physical reality, explaining what it means as it unfolds. This is about recognizing a pattern and positioning before the crowd realizes what's happening. Now I want to hear from you. Where do you think the price of silver is going? Do you think we break $80 this month? Are those $200 predictions realistic or crazy? Leave your comment and tell me your analysis. Because the conversation matters, and the best insights often come from you, the audience. Thank you for watching. I'll see you in the next video where we dive deeper into what happens when that cap finally breaks. The strange behavior is not random. It's suppression, and suppression creates the most explosive breakouts. We're about to find out just how explosive this one will be. Now, let's unpack this a bit more, because to really grasp the magnitude of what's happening, you need to understand the mechanics behind this price suppression. For years, the silver market has been a tale of two worlds. On one hand, you have the physical market, where real silver bars and coins are bought and sold. This is the world of industrial demand for solar panels, electronics, and EVs. It's the world of investors wanting a tangible asset. On the other hand, you have the paper market, dominated by futures contracts on exchanges like the COMEX. This market is 100, maybe even 1,000 times larger than the physical market. It's where price is discovered, or more accurately, where price is often dictated. The problem is, the paper market has become disconnected from physical reality. Large financial institutions, often called the bullion banks, have historically held massive short positions. They've been able to sell paper silver they don't actually have, effectively flooding the market with artificial supply and keeping a lid on the price. This works as long as no one asks for the physical metal. But that's exactly what's starting to change. We're seeing a massive drain on physical inventory from the major exchanges. The vaults at the COMEX and the London Bullion Market Association, or LBMA, are seeing their stockpiles shrink at an alarming rate. Why? Because industrial users and large investors are bypassing the paper games and demanding real physical delivery. Think of it like a game of musical chairs. There are 100 paper claims for every one physical chair. As long as everyone is happy, just trading the paper claims, the game continues. But now, more and more players are deciding they want to actually sit down. They're cashing in their paper claims for a physical chair. As the chairs get taken, the remaining players start to get nervous. The music is getting faster, and they know there aren't enough chairs to go around. This is the situation we're approaching in the silver market. The physical demand is draining the available supply, and the paper players who are short are getting squeezed. They promise to deliver silver they don't have, and to get it, they'll have to buy it on the open market, pushing the price up. This is what we mean by the structural deficit. For years, the world has been consuming more physical silver than it produces. The gap has been filled by drawing down existing above-ground stockpiles. But those stockpiles are not infinite. They are dwindling. And you can see the stress in the system through various signals. Look at the premiums on physical silver coins and bars. They've been stubbornly high. This premium is the extra cost you pay over the spot price to get your hands on the actual metal. A high premium tells you that physical silver is in much higher demand and shorter supply than the paper price would suggest. It's the market screaming that the paper price is a lie. Another key indicator is the backwardation we sometimes see in the market. Normally, a futures contract for delivery in the future costs more than the current spot price. This is called contango. But when the market flips into backwardation, the spot price is higher than the futures price. This is a very rare and bullish signal. It means people are willing to pay more to get the metal right now than to wait for it in the future. It's a sign of extreme physical tightness and desperation for immediate supply. We've seen flashes of this, and it's a huge red flag that the system is under strain. So when we talk about this 74.55 cap, it's not just a random number. It represents a line in the sand where the paper managers have desperately tried to halt the price advance. Every time the price approaches this level, we see a massive volume of sell orders appear out of nowhere, pushing it back down. This isn't normal market behavior. It's the signature of coordinated intervention designed to prevent a breakout. But you can only hold back a tsunami for so long. Each time they push the price down, more physical silver leaves the vaults. The fundamental pressure builds. The spring gets coiled tighter and tighter. And this brings us to the industrial demand side, which is the non-negotiable part of the equation. Silver isn't just a monetary metal, it's a critical industrial commodity. It's the most conductive and reflective metal on the planet. Its use in solar panels is exploding as the world transitions to green energy. A typical solar panel requires a significant amount of silver, and with global solar installations booming, this demand is forecast to grow exponentially. Then you have electric vehicles, 5G technology, and countless other electronics that all rely on silver. This demand is largely inelastic, meaning these industries will pay whatever they have to in order to secure the silver they need. They can't just substitute it with another metal. If the price goes to $80, $100, or even $150, they will still have to buy it. This inelastic industrial demand is on a collision course with the dwindling supply and the paper market manipulation. The force of real-world economics is about to overwhelm the artificial financial engineering. When that cap at $74.55 breaks, it will be a signal to the entire world that the game has changed. It will be an admission that the paper shorts can no longer control the price. The algorithms that were programmed to sell at that level will be turned off or run over. The buyers who were waiting on the sidelines will rush in, fearing they'll miss the move. This isn't just a technical breakout on a chart. It's a fundamental regime shift. It's the moment the physical market finally reasserts its dominance over the paper market. Think about the psychology of this moment. For years, investors have been told that silver is a losing game, that the price can't go up. Many have given up. But when the price not only breaks that long-standing resistance, but does so with explosive force, the narrative will flip overnight. The mainstream financial media, which has largely ignored silver, will suddenly be talking about a historic breakout. New investors, who never considered silver before, will be drawn in by the momentum. This is how bubbles are born, but in this case, it's a bubble being inflated from a point of extreme undervaluation, driven by real-world fundamentals. We're moving from a period of stealth accumulation, where only a few informed investors were buying, to a period of public participation. And that's when you get the truly parabolic price moves. It happened with gold in the 1970s. It happened with palladium a few years ago. And all the signs are pointing to silver being next. The key is to understand this setup before it becomes common knowledge. The opportunity is now, while the price is still being artificially held down. The opportunity is in recognizing that the pressure is reaching a breaking point. So let's keep a close eye on these key signals in the coming days and weeks. Watch the COMEX and LBMA inventory levels. Are they continuing to fall? Watch the premiums on physical products. Are they staying high or even increasing? Watch for signs of backwardation. And most importantly, watch that $74.55 level. The battle for that price point is the battle for the future of the silver market. When it breaks, it won't be a small move. It will be the start of a major repricing event that could take silver to levels that seem unimaginable today. But they are not unimaginable when you understand the incredible forces at play. This isn't just speculation. It's about connecting the dots of a global supply and demand imbalance that has been suppressed for far too long. The breakout is not a matter of if, but when. And it looks like when is getting very, very close. Don't forget to share your price targets below. I read every comment, and the shared knowledge here is invaluable. Stay vigilant, and I'll keep you updated.